Hey everyone, welcome back to another exclusive podcast from IronFX, where we're dedicated to bringing you the absolute best education to help you take your trading to the next level. I'm your host, Desmond, and today we're tackling a term that's been buzzing in financial circles, stagflation. What is it? Why are global trade tensions making it a bigger threat? And how could it shake up the portfolios of investors and traders? Let's dive in. First, let's break down stagflation. In economics, stagflation is a rare and nasty combination of stagnant economic growth, high inflation, and high unemployment. Picture this: prices for goods and services are skyrocketing, but businesses aren't growing and people are losing jobs or struggling to find work. It's the worst of both worlds. None of the prosperity you'd hope for with inflation and none of the price stability you'd expect in a slowdown. The term gained fame in the 1970s when the US and other economies got hit by oil shocks, spiraling prices, and sluggish growth. Unlike typical inflation, where demand drives prices up, stagflation often stems from supply-side issues like disrupted production or soaring input costs. It's a headache for policymakers because fighting inflation with higher interest rates can worsen unemployment, while boosting jobs can fuel even more inflation. So why are we talking about stagflation now? Global trade tensions are a big reason. In recent years, we've seen escalating tariffs, trade wars, and supply chain disruptions. Think US-China tariffs, Brexit, or sanctions impacting global commerce. These tensions choke the flow of goods, raw materials, and components, driving up costs for companies. When businesses pay more for inputs like semiconductors or energy, they pass those costs to consumers, fueling inflation. At the same time, trade barriers slow economic growth. Restricted markets mean less trade, fewer exports, and weaker corporate profits, which can lead to layoffs and higher unemployment. For example, if tariffs on imported steel raise car prices, consumers buy fewer cars, automakers cut production, and workers get laid off. The result? Rising prices, stagnant growth, and job losses, the perfect recipe for stagflation. Many economies, from the US to Europe to emerging markets, face these risks as trade disputes disrupt supply chains and erode confidence. Now, let's get to the big question. How does stagflation affect investors and traders? Spoiler alert, it's not pretty. Stagflation creates a brutal environment for most asset classes. Stocks, especially growth stocks like tech, tend to suffer because high inflation erodes profits and weak growth tanks revenues. Value stocks or defensive sectors like utilities might hold up better, but even they're not immune. Bonds get hammered too. Rising inflation eats away at fixed income returns, and central banks may hike rates to tame prices, pushing bond yields up and prices down. Cash isn't safe either. High inflation erodes its purchasing power. Commodities like gold or oil might offer some protection as they often rise with inflation, but they're volatile and not a sure bet. For traders, stagflation demands agility. Volatility spikes as markets grapple with conflicting signals, creating opportunities for short-term plays, but also big risks. Option strategies like hedging with puts can help manage downside. Investors, meanwhile, might lean into inflation-resistant assets like real estate or TIPS, Treasury inflation-protected securities, but diversification is key. The trick is staying flexible and not getting caught flat-footed by sudden policy shifts or economic data. And that's the lowdown on stagflation. It's a rare but toxic mix of high inflation, weak growth, and rising unemployment, made more likely today by global trade tensions. For investors and traders, it's a minefield that demands caution, diversification, and quick thinking. That's all for today's episode. Thanks for tuning in, and in the meantime, do remember to subscribe to our podcast here at IronFX, where we're dedicated to bringing you the very best education to take your trading to the next level. Until then, stay informed and stay tuned.